the three topics that we experienced people talking about were crypto, which kind of had gone away for a while with crypto winter and Sam Bankman-Fried, but it's kind of starting to rear its head again. Fixed income was a pretty big topic down in Boca. Obviously, there's a lot of rules coming down the pike about mandates for clearing, mandates for repo. And then India. India was something that a lot of people were touching on, getting access to India, trading in India.
What was the crypto discussion?
Everybody and their brother wants to trade crypto, but I feel like they're not sure where to start, where to go, how to trade it. There's a handful of exchanges out there that are starting to get into crypto. I feel like not only do we talk to a lot of clients that wanted to trade crypto, but we talk to a lot of exchanges that are like, hey, we got a great idea. We're going to launch crypto futures. I'm like, yeah, you and everybody. And so, it's going to be tough to see who survives. And I think a case of that is Cboe Digital, which just happened this week with Cboe Digital. It's unfortunate, but they kind of pulled the plug on that project. And, I'm sure those futures may still get launched, but it's hard enough to get people to trade S&P 500 futures, let alone trade crypto futures. So when there's 10 to 12 different venues out there to get exposure to crypto futures, who's going to win? It's anybody's game. I think what's been successful out of the gates has been the crypto ETFs. And you've seen a lot of the net asset values that some of these funds have raised like very quickly, are in the billions. I think the options, people are wondering when there's going to be options listed on some of these ETFs. For us, we haven't made that much money off crypto. It hasn't been that exciting, but it's definitely something we're going to, keep following. I think, when the Eurodollar pit first opened at the CME, there's probably two guys standing in there and it became the CME's flagship product. This could be the same for, crypto in the derivative space, but I think time will tell.
What kind of demand have you had to connect to FMX?
We've had a handful of clients ask us about it, and I think a lot of those clients genuinely think that there's room for competition in fixed income derivatives. I think some of those clients that have contacted us, have an arrangement where maybe they're an investor in the exchange, which there's nothing wrong with that. People make investments all the time, but we've had decent demand. I think for us, the challenge there is that it's a new CCP. It's a CCP in London that only US FCMs can join, which makes it challenging. It's one thing if like we're at an options conference here, if a new options exchange pops up, it's pretty easy for us because we clear the OCC and all options exchanges, all that volume clears the OCC. And for us, we don't really, we're agency only. So we're not trading ourselves. Our clients are the ones writing to the exchange's API and connecting to the exchange themselves. We just take the feed in, post trade. So, it's something we're considering. And we've had some client demand, but, time will tell. We have competing projects out of it.
Are there other venues where clients want to trade?
The cash side, what's interesting about the cash side, what's interesting about cash markets in general is nobody really has an exclusivity on US debt, right? Like you and I can start an ECN tomorrow. We'll call it JLN ECN, and we can list US government securities, like where somebody, has a right on the S&P 500 future. There's a licensing agreement, there's trademark agreements, but nobody has a right to own yen. Nobody has a right to exclusively list US debt. So you and I can, come up with an ECN and trade there. So there's 4 major ECNs that a lot of our clients are trading on. But what a lot of our clients have done over the years is they've kind of turned into like mini dealers, right? Where you used to go on a proprietary trading firm's website, a few years ago, and it was like a picture of Saturn. And you were like, what the hell do these guys do? And it's like, they're super secretive. Now these same firms have a sales staff, and that sales staff is down at conferences here and going and selling themselves as liquidity providers. So, not only do those clients want to trade on those lit exchanges, they also want to trade directly with a hedge fund and say, hey, look, before you trade on, ECN1, ECN2, ECN3, come to me and I'll make you a price myself. And we can just kind of match up and trade the trade and send it to FIC to be cleared. So for us, most of our clients are kind of looking like mini dealers and, starting to market themselves as liquidity providers. Some use the venues, some have to use the venues because it's a lit product. But, so there's a lot of people that want to trade in that way.
Where do the alignments and misalignments occur for clients and FCMs when assessing new trading opportunities?
Sometimes the misalignments come where, some of the exchanges get everybody hot and bothered, early on. Hey, there'll be a stipend, there'll be some sort of rebate program for you to make two-sided markets on this exchange. We need you to be there day one. And everyone, will want to jump at the opportunity. They kind of view that as, some easy money to be made. But then they ask the clearing firms traditionally last. And then they kind of assume they're like, hey, you'll connect to us, right? And it's like, well, where's our stipend? And, for us, what's challenging is that we're agency only. So we don't have a Delta One desk. We don't have a prop trading desk. Some of our competitors have desks that trade swaps, that trade interest rate products, that trade equity products. We don't, but we bring a lot of volume. And so for us, we're kind of trying to, flip the script a little bit and say, hey, you're giving a lot of stipends out there. You're giving a lot of equity out there. You're giving a lot of, warrants in the new company. We want to see that too. So if we can get aligned on those interests, I think we have more success in joining some of these exchanges. Where other challenges kind of lie is just liquidity in general. Like I think that you'll start to see liquidity tighten up, this year and into the end of the year. I think we've had a lot of volatility. We've had a lot of volume early on. And I think people are forgetting that there's an election. And the last time Trump was elected, it was our second highest volume day ever in the history of our firm. And there's a lot of things that he's talking about now that could be like, okay, this is just those thoughts in general could create a lot of volatility. You're sitting at all-time highs in interest rates, and there's no sign that the Fed's going to move rates lower anytime soon. There's a lot of geopolitical concerns. And so when all these events happen, everyone wants to get balance sheet, everyone wants to get liquidity, but liquidity can get, tight. And that's sometimes where we're misaligned with our clients. The cost of capital, what they want to pay for liquidity. And there's been this kind of race to zero over the years from a clearing perspective, which I feel like the clearing firms are the lowest paid people in the totem pole. You have the exchanges making a lot of money, you have the clients making a lot of money, and you have the clearing firms making the least amount of money, but they're kind of the note from the mom that says, we'll guarantee these trades, so that seems like a lot of risk for not a lot of reward. So hopefully that'll just continue to change and we won't be misaligned on it. And I think a lot of our clients are good partners. They know that we need to get paid. They know that they need to make money. And so sometimes there is that strife where, we say to them, hey, look, this isn't the best return on our balance sheet. This isn't the best return on our capital. And they understand it.
Are zero DTE options interesting to futures traders?
Some people think that they could do the job that futures have been doing for the last, umpteen years, because people might say, hey, it's a more precise way to hedge your portfolio. Some people think that. Some people think that it's just, hey, look, this is a bunch of speculators out there trying to get a couple lotto tickets before they get to work, that morning. But I think that there's not a lot of people looking at intraday volatility and saying, hey, look, what could happen if, a U.S. sitting president passed away during the day? What could happen if the Fed made a surprise rate hike? What could happen if a company that was a large component of the NASDAQ filed for bankruptcy midday? Like, what do those intraday volatility events look like? And how does that affect, zero DTE exposure? And do clearing firms have enough capital up and enough margin up for these zero DTE options for those cataclysmic events that could happen intraday? I think there's firms out there that have not just one day risk, but short dated risk. Like, I need to move product A, across these two pathways, or I need to move product, from A to B, and it's going to take me 3 days to do it. And I'm worried about X, I'm worried about Y, I'm worried about Z. I want to get a short dated option on it. So I think there's plenty. I think what you could say is that maybe the benefit of short dated options or zero dated options allow people to get more precise about their risk. And if you think about that back in the day with Euro dollars, for example, they used to not have like red packs and green packs and 2-year bundles and the strips, and I think people, if the only vehicle you were able to use to hedge treasury risk was a 2-year future, well, you're like, I have my 2-year future on, but I really don't need to hedge the stuff in the front of the curve because it's not moving. And I'm not going to have the risk on anymore. The risk is going to kind of start maturing off of the back of the curve. So I need these little finite products, that can make up for a 2-year. Hence Eurodollars, Septis March June, Septis March June. You want not as much, in the beginning. You want a lot in the middle. You don't want as much at the end. So I view zero DTs as something very similar, where maybe you can get more precise in your hedging.
What is the outlook of ABN AMRO on the floor?
There were some thoughts at ABN AMRO that we didn't want to be the last, floor firm standing. We were punching a lot of trades, but then slowly pit started closing, and the only pit that was really left open was the SOFR pit. And I think, if I would have sat here 10 years ago and you would have said, hey, do you think you'd be doing volume on the CME floor still? I probably would have said no. But I think we're doing more volume on the CME floor in one pit than we've done in the last 20 years in all the pits. And so it's been pretty successful. For the CME, I think it's been pretty successful for a lot of our market making clients. A lot of complex orders, a lot of complex structures still trade on the floor. And you see that with not only the CME group, but you see that with the CBO, like the two pits that are open, in Chicago, the CBO floor and the CME floor. There's a lot of volume going through those floors. So, it's kind of shocking that, we didn't think we were going to need key punchers anymore, but we probably need to find some of those people and bring them back.